Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and one of the founding partners of the Dividend Kings marketplace service here on Seeking Alpha. You know, I've been doing this a very, very long time, and lately, in more recent years, I've been really focused on dividend growth and dividend income. All the reason why I decided to become a partner in the Dividend Kings service here, because I do believe one of the real advantages about investing in high-quality dividend growth stocks is the idea that you can get a raise in pay every year if you build the portfolio properly and design it properly. But I also think you need to understand clearly as you can the dynamics of what that really means. So there are a couple of important things I think you have to consider. Number one is you have to recognize that valuation when investing in dividend growth stocks is critically important. The reason I stress valuation so much, and I even go as far as to say, as I said in the article, you know, measuring performance without simultaneously measuring valuation is a job half done. The reason that's so important is because, you know, valuation is going to really have an impact on how much money you make, how much risk you're taking, and how much dividend income you're ultimately going to receive. And the key of focusing on only investing in a stock when it's trading at a fair value is that you then position yourself to participate in the growth of the company. And ultimately, it's the growth of the company that's going to determine the rate of return that you make, how much money you're going to make and how much dividend income you're going to get and how fast it's going to grow. So I'm going to go over 4 or 5 companies here with some different various growth rates, and I'm going to be looking primarily at earnings, although I do want to point out that when I'm looking at dividend growth stocks, I always focus on operating cash flow, free cash flow, even cash flow related metrics such as EBITDA. But, you know, as far as which one of these are my favorite or which one is best, my argument is I always use all of them. That's why I incorporated them into my FastGraph tool here, because I want to try to analyze and get as much information and perspective as I can. But every FastGraph tells a data story, if you will. It tells you a lot about the business. So if I'm looking at a company here like AmerisourceBergen, strictly from the numbers point of view, this orange line is earnings per share, and it's earnings per share at a multiple of 15, which is a historically normal valuation reference, kind of a midpoint reference for stocks. So the point is, the first thing I want to do is I want to measure the growth. Now, Amerisource is actually a very fast-growing dividend growth stock. Their earnings growth has averaged 12.79% since 2005. Now, this company has a September fiscal year. So the graph is drawn in calendar years, but it's also drawn in fiscal years. I want to make that clear. So what I've got here is earnings, and I've got earnings growing at almost 13% a year. So now, if I incorporate monthly closing stock prices onto this graph, I want you to notice that in the long run, the stock does tend to move in tandem with the earnings. That's critically important. This orange line represents the fair value, and I chose this particular time frame with this particular company because the stock is essentially in value or slightly undervalued. The PE on September 30th, the fiscal year end for 2004, was trading at just under 13 times earnings, and it's currently trading at a very similar PE now. So now I've got matching PE ratios, if you will, to beginning and the end, slightly a little bit higher at the end. But now I can argue that I'm going to participate pretty much in the growth of this business from a capital appreciation point of view, and maybe get slightly better because my PE of 13.71 is slightly higher than the PE of 13.25 when I bought it. So I'm going to very quickly go into performance here, and I want to look only at the capital appreciation. In other words, the price of the stock going from point A to point B over this 18, 19-year time frame. So looking at buying the stock on September 30th, 2004, a $10,000 investment would have grown to $84,522.57. That's a 14% annualized rate of return. The point is, that's extremely consistent with the 12.79 or almost 13% growth rate with a little bit of PE ratio expansion built in. Now, the point is how fast the company grows, especially if I buy it at an attractive valuation, is going to determine how well I do, you know, with the investment. Now, I'm going to use this as an example because I'm going to cut a couple of years off here, and I'm going to look at this same stock where I'm buying it when it's overvalued, when the PE was 20. Same company, slightly different time frame, and it's got an ending PE of 13. So now when I look at performance, my rate of return is 12%. but the company has grown it during this time frame at over 14%, so I got slightly less than what the business was capable of generating for me. So the idea is you want to try to buy these stocks or any dividend growth stock when the price is in reasonable alignment with the intrinsic value of the company, and then you want to hold it for the long run. Now, in addition to this capital appreciation, of course, we've got dividends. So now I'm going to add a plotting of the dividends and the dividend payout ratio. Now, there's two things I want to make here, 2 points I want to make. Number one is the area below this white looking line here represents the portion of these total earnings paid out. I want you to notice that this stock has a relatively low payout ratio. In 2019, the payout ratio was 22%. In fiscal year 2020, which ended in September, it was 21%. But I also want you to notice that back here in these early years, the payout ratio was only 7%. So this is really more of a quasi-growth stock that started paying a dividend, and has historically been paying a dividend, but a dividend was secondary to the company, but it's becoming more and more important. So now when I go into the performance and review that, I had these extremely low dividend payout ratios in the beginning, and then I got into some double digit, in 2008, I actually got a 10% payout ratio. And I want you to notice that through the recession, this company grew their dividend very strongly. I think that's very, very important. But what happened was we ended up with almost a 30% dividend growth rate here, even though the company only grew by about 13%, because we also had payout ratio expansion over this time frame. This company is capable of generating those dividends. Now, I also plot dividends on top of the orange line to make the point that your performance, your total return is going to be capital appreciation, the stock going from $13.03 to $110 over this time frame. That's your 14%, 10,000 grows to 84,000. But then you also receive $9,471, if you will, rounded, of dividend income, significantly more than, by the way, the market. You made significantly greater capital appreciation than the market because this stock grew faster than the average stock in the market. And you end up with a total rate of return of 14.8%, which is kind of consistent with the company's earnings growth rate. It's that earnings growth and dividend growth coupled with the valuation you pay that's going to determine your rate of return. So I've got a couple more examples here with some different growth rates. The next one I'm going to look at is Amgen. Now I'm going to start out with the long-term graph here because what's interesting about this company is, and you can see that very quickly on the fast graph by looking at these dividend iterations, company didn't start paying a dividend until 2011, number one. And you can see that the payout ratio was relatively low, about 10% when they first paid it, but then they raised it to 22%, then they raised it to 34%, and last year they paid out about almost 40%. So again, we've got dividend payout ratio expansion. So let me shorten the time frame here and get into where the company started to pay a dividend. So you can see they paid it in 2004. So I'll go ahead and shorten the time frame. Also notice what's happening here. I should have pointed out before I switched. The growth rate during this time frame was 10.5%. I cut these 2 years off, and now the growth rate's 11.76%. So this is another fast-growing stock. Now, I also have a normal PE line, which I've been ignoring, and I'm going to continue to ignore, because in this case, it's very, very similar. It's a range. Valuation is always a range. Notice the volatility of the stock price. So it's always going up and down, and it's getting overvalued sometimes and undervalued, but staying within what I would call a reasonable range of valuation here. So we've got 11.76% growth. I look at my performance. I've got 15.4% capital appreciation, plus dividend income of over $5,000, which was more than the market produced over the same time frame. Now I'm only measuring 2011 through 2021. But the point is I got a nice strong dividend growth rate. The dividend has grown on average at over 30% again. So now we've got, two examples of two very strong companies, but I do want you to notice it's the success of the business that is determining these rates of return as well as the dividend growth. And these are both, two very high growth examples. Now let me move on now to AROW Financial, which is a slower growing business. This company has only grown earnings at, well, just under 5% during this time frame that I've got up here on the screen now. It's a regional bank. But I'm going to shorten that because right now I've got a lot of undervaluation and I've got slight undervaluation here. So I'm going to shorten the time frame from 2001 to 2004. And here what I want you to see is you've got about a 3.8% earnings growth. This is such a critically important number here because that earnings growth is going to be a strong determinant of your capital appreciation as well as the amount of dividend income you receive. Because as you notice, the stock price tends to follow the earnings line over time. It definitely gets disconnected and it's never a perfect fit. That's why these numbers aren't perfect. But when I look at performance, I've got 3.3% annualized rate of return or capital appreciation, if you will, that the company's generated. But I got a very strong dividend record over this time frame, which gives me a significantly more dividend income than the market, but I underperformed the market in this case because this is a slower growing, more, it's a regional bank. It's really more of an income investment, has a very high current yield of 3.31%. The dividend growth rate, I also want to point out, has only been about 3.8%, which again is very consistent with how fast the company grew. So the dividend has grown in tandem with the earnings. But the point is, what's generating that is the success of the business. It's the success of the business, the fundamental value of the business that matters most to you. And then moving on, I'm going to look at a cyclical stock. Now let's go look at Cummins Engines. And Cummins is a quasi-cyclical company. And what I mean by that is you can see that it has periods where earnings drop, like coming out of the recession of '08. Then they rose real strong. Then we had a couple of down years, then a strong up year, then a couple of down years, then a couple of strong years, and a down year. Now we're expected up years again going forward. But in spite of all that, this company's been the fastest grower so far. Its growth over this time frame has been about 15%. Now, if I look back here, you can see that the stock is pretty close to touching the orange line. It's trading at a 14 PE. Now I've got an ending PE of 21. So I've got this 15% growth. It's been cyclical, however. I want to make that point. When I look at performance here, I get a 17.5%. $10,000 in Cummins would have grown to $252,000 since December 29th, 2000. Burying the market, just destroying the market because it grew so much faster, and it generated almost $40,000 in dividend income, significantly stronger than the market. Now, I think this stock is a little pricey today, but it would obviously been a great buy, back in most of 2019, certainly during the original COVID epidemic or pandemic, it would have been a really excellent buy. But anytime you could buy this stock below the earnings line, it would have been an attractive buy. But again, I want to point out it's the success of the business that generated the total capital appreciation and also the dividend growth. Again, you see the dividend growth growing at around 17% a year, either compounded or average. And again, that's reasonably consistent with the 15% growth rate. Once again, I do want to point out we do see some PE ratio expansion here in the more later years. But again, what I'm really focusing on here is the source of the rates of return. Where are the rates of return that a company, a dividend growth stock, generates on the shareholders' behalf? Now, here's General Mills. I'm going to expand this out a little bit. Company's grown about 6% a year. Normal PE, the market tends to value this at a little higher valuation, so you could almost argue that it's undervalued because I guess, General Mills is a pretty stable company. When I look at performance, I've got 4.9% average capital appreciation. Not slightly underperforming the market on capital appreciation, but close, 5% versus 5.3 or 4.9 versus 5.3. But I got more than twice the dividend income off of this, dividend stalwart. So I actually ended up generating a higher rate of return than the market over this time frame. But once again, that 6% adjusted operating earnings growth correlates very strongly with the 6.6% total return that I got, because in the long run, earnings drive market price and dividend income, which is the basic point of this article. So there you have some various growth stocks. I'm going to end this with one last example. I want to bring out a kind of a slower growing, it's called a multi-utility, but it's a utility-oriented company, because I want you to understand something about this. These relationships are very profound and very important. However, investing is not a game of perfect. So I want to close with that. This I thought was a really good example, because what you see here is an awful lot of price volatility. You have this 4.26% earnings growth rate, if I look at performance over this time frame, it's very consistent with what the company achieved on capital appreciation. The company does pay a dividend. The dividend has grown at about 3.5% per year. And again, that's consistent with the earnings growth rate of about 4%. When I say consistent, it's not identical, but it's in line with it, if you will. But here's the point that I really want you to see on this particular graph. You will get crazy market valuations on stocks. Here you have an example, it's really kind of interesting to me, was the price and the operating results tracked pretty well up until we got to about 2012. And then since then, during this raging bull market we've been in coming out of the Great Recession, we've had 3 distinct periods where the stock has gotten significantly overvalued, trading at very, very high multiples, in the 20s, where its theoretical fair value multiple should be 15. But I want you to notice in each case, the company eventually reverted to the mean, and it did it in a sequential time frame here that's pretty close. But the point is that you're going to run into situations where a stock, like if I measure the performance of this stock from its low point in 2008 to its high point in 2022, I would have made 17.3% per annum. I'd have received, a significant amount of dividend income, but I would have turned, I would have got a 5.5 times my total investment, 4.6 times my investment in capital appreciation alone, even though my growth during this time frame was actually relatively low. And the point I'm getting at is measuring performance without simultaneously measuring valuation is a job half done. When you're looking at your performance, you need to also look at the valuation that performance has been generated by. If I overpay for the stock, in contrast, and held it, for the 4 or 5 year period I've drawn here, I end up actually losing money on capital and get a squeak out just a break-even rate of return, if you will, only because I got some nice dividend income. So valuation is critical, but the source of what you're going to make when you invest in any stock for that matter, but a dividend growth stock especially, the amount of dividends and the amount of capital appreciation you're going to receive is going to be functionally related to how well the business does. That's why I call this business perspective investing. It is value investing, but it's investing in the business and in a way that you participate fully in the business. Anyway, this has been Chuck Carnival wishing everybody a happy new year now that the new year's over and we got 2020 behind us. Let's all hope for a much more pleasant 2021. Thanks for watching and thanks for reading.